Good morning, everyone on the West Coast, and for those of you that may be in a different time zone, good afternoon or whatever's appropriate. I think we've so recently markets have been on a bull run, but in the last couple of years we've seen an incredible amount of market volatility, and really because of that volatility, I thought it was important to assemble a panel of 115 experts so that they can address some of the questions that may be on your mind, perhaps give you some food for thought of questions that you may get from council members. I think we have an all-star cast to answer those questions. And with that, we'll kind of move into the webinar. Before I introduce the speakers, a little bit of housekeeping in that we will provide a copy of the slide deck after the conclusion of the webinar. If you have questions during the webinar, use the chat box. I'll try to really push those questions to the end of the webinar unless it is feel that it's a good opportunity or timely to take the question in the beginning, but with the number of speakers, we do need to make sure we get through the information. And then, of course, if you have questions after the webinar, please reach out to success@govinvest.com. And I've also included contact information of our panelists. Our first panelist is Matt Goss from the CalPERS CERT and SEPT program. I've known Matt for a long time, and he brings a wealth of knowledge from the CalPERS SEPT and CERT programs. Next, Dennis Mullins from US Bank will do some of the heavy lifting with respect to the capital markets as we see them today. Another long-term colleague and friend, Carlos Oblitas from Chandler Asset Management, brings a wealth of knowledge from work for various entities, including Wells Capital Management, PFM, and now Chandler Asset Management. And he also had a brief stint as a finance director in the local agency. So he can also empathize with some of the questions that you may get. Equally, Ellen Clark, known for a long time as well, and she brings a wealth of knowledge from PFM Asset Management, and she is just a wealth of knowledge in all things related to multi-asset class portfolios. Myself, I am a senior client advisor for GovInvest. GovInvest is a technology firm that provides various forecasting tools for pension, OPEB, forecasting, labor costing, et cetera. And so feel free to reach out to me if there's some specific questions that I can answer or at our help desk. Ryan Nicasio is also a supporting resource for PARS specific questions. Dennis will be really representing both PARS and US Bank to a certain extent, or US Bank and PARS to a certain extent. And then, of course, we have David Teichart, who heads up the employer stakeholders group, or stakeholder relations at CalPERS, and he is another great resource to have at our disposal. So some of the questions that I posed, why use a 115 trust? Matt Goss will speak to that question today. Where are markets headed? That will be Dennis Mullins addressing Matt. And what an agency. Now, one of the common problems I've seen is that folks haven't really identified how they're going to use their 115 trust, and it makes it a little harder then to determine what's an appropriate strategy. And so Carlos Oblitas will speak to that question, as well as some technical differences between strategic versus tactical asset allocations, and address this tricky question that you all may get, is that how to explain the likely underperformance of your 115 plans relative to CalPERS, PERF, or similarly structured portfolios that have exposure to private assets. And then we will turn it over to Ellen to talk about why not just pick the best performing asset allocation. And of course, we're all waiting with bated breath what to expect from markets moving forward. And Ellen, of course, will showcase her crystal ball or not. So hang tight. So with that, I'm going to turn it over to Matt Goss to speak to why use a Section 115 trust.
Thank you, Dan. I appreciate it. So one of the main reasons that employers who I've been working with would use a 115 trust, and in this case, we're talking about pension, but we can also use the same example in the OPEB space, is to save money by saving money. And so by putting money in a irrevocable trust account, you usually build up a larger asset base. You expose that to a higher yield environment than an alternative option, such as, let's just say, LAIF or county treasury or short-term fixed income option. And you earn more interest over time. And with respect to time, and my other peers who are going to be talking, I think you can look at this slide here on the right, where it goes over the rule of 72, and you can see that if you give an investment more time, that it will grow at a higher rate of return. This one here focuses on doubling your money over a time period, but nonetheless, I think three factors are really important. One is, how do I retain as much of my liquidity as possible? How do I maximize returns as much as possible at a given level of risk that's acceptable to my organization? So with that being said, let's take a closer look at pension cost management tool options for employers in addition to 115 trusts. So on the table, we have things such as making actually determined contributions. We have the 115 trust, as aforementioned. We have paying down debt to a pension system as an example. That debt would be technically referred to as unfunded accrued liability, or UAL, but doing that faster than the system requires you to do it on an annual budget cycle basis. And when doing that, for example, you can pick different debt bases to pay off and do so strategically to maximize the outcome in your direction that's desired. Sometimes generating revenue may be difficult, so agencies look at options like issuing pension obligation bonds and using those assets or those proceeds to pay down debt with a margin that they believe will be favorable to them over the long term. And there are other options that we may get into. With respect to time, I'll keep moving. So with respect to UAL-based consolidation options, so when making an additional discretionary payment, you do have options. In addition to that, re-amortizing is usually what you do, and you get a consolidation of these different amortization bases, and you roll them back up into a different time period for some sort of strategic reason. And there are details here that go beyond the scope today, but we can talk about them if somebody wants to. Next slide, please, Dan. So the purposes specifically of the 115 trust, from my perspective, from our client's perspective, from I think most of the panelists here that we hear, are to grow assets for future pension contributions. So here we're talking specifically about a 115 trust in the pension space. This would also allow you to invest over different time horizons than, let's say, the pension fund's asset allocation, with, in addition to that, different risk exposures than the pension fund's usually sole asset allocation. This may allow you to earn higher yields than shorter term fixed income portfolios, things like LAIF, county treasury, and other alternatives. This would definitely allow you to retain liquidity on your assets in the 115 trust, which can be a huge advantage for future moves on the chessboard. as opposed to just sending the money directly to the pension system where you cannot get it back out. The liquidity is gone. All of this can help stabilize future budgets. And some of these products in this space actually utilize that type of terminology in their naming convention, and appropriately so, because this can definitely help make your life more sane in the future as it relates to budgeting. You can create contingency reserve funds for expected volatility in the pension system. Let's be frank, the asset allocation used for investing pension assets to pay these benefits, they are volatile. And we need to be honest and expect that volatility and plan for that volatility if we want to optimize our performance and our participation in these types of systems. And you can save overall costs by pre-funding them in advance. An example would be an employer who's 100% funded but still wants to save money by pre-funding normal cost in advance and taking time and making it an ally as opposed to some indifferent thing. Next slide, Dan, please. So on this slide, I just give a brief example, and this will be my second to last slide here, and then I'll pass the baton, of the tools that are in an employer's toolbox. And two of them are pretty much already there. The pension fund in which you participate, which has the highest expected rate of return normally. And then also, these short-term fixed income tools, what we're calling them, but an example may again be LAIF or county treasury or a money market account or something with one of the firms here today. But these usually have the lowest expected rates of return. Now, on the flip side of that coin, the pension fund would probably always have the highest level of risk exposure or volatility measured by standard deviation, whereas that shorter term fixed income account would have the inverse, the lowest. And the pension fund has a long-term time horizon, whereas these short-term fixed income accounts have a much shorter term. Liquidity, you can see, is inverted. With the pension fund, as I mentioned, there is none. With short-term fixed income, there is. So the 115 trust sits nicely in between these two as a comparison between them and works harmoniously with them. So my argument is that you would use them all together interchangeably, and we can dive into that with questions and answers later. But you can see that the level of expected return and risk exposure and investment time horizon are determined by you, the employer, and you control the funding policy, and that makes it very nice for you. And you also retain the liquidity. So this may be a great example visually to help you understand how you would set these tools up and use them all at the same time to maximize your benefits. And then finally, what we would propose is that you consider a balanced approach where you're not just picking one of those tools, but you're using, many of those tools. And probably the two that we're talking about is additional discretionary payments made to your pension system. I work at CalPERS, so we can use CalPERS as an example, which do a great job of reducing net pension liabilities, and your financial statements will look better, but they may have different levels of impact on future contributions, and that may or may not be important to you. The Section 115 trust would allow your agency to control cash flow to the pension system by storing that money in a 115 to augment future contributions, as an example, but earning generally more money than those short-term fixed income accounts. So some great benefit. And this just allows the ability, creates the ability, quite frankly, to stabilize contributions over the long term, as I had mentioned. So I want to thank Ellen Clark from PFM for letting me borrow this slide. Appreciate you very much, Ellen. And Dan, thanks for your time.
We'll pass the baton over to Dennis, and he will, as I said, do some of the heavy lifting, answering where are markets today.
Thank you. I appreciate it. I'm going to speak more to what's been happening in the markets looking backwards, and that's related to, but obviously much easier than looking out into the future. So the chart that you have in front of you is about a 25-year slide of the S&P 500. And it's always difficult to decide what time period to look at when you're trying to look backwards and find relevant markets to gain some perspective. But for everybody who's trying to digest the recent decline in the market, this is a good perspective to add. Over the last 25 years, you can see obviously the trend is up. The up and down volatility is the noise. And despite the fact that we began this year with a 20% decline in the S&P 500. Let's go to the next slide, please. For the 5 years ending July 31st of 2022, that includes the the precipitous decline in the first 6 months of this year. You can see that stocks have still, even with that loss, have returned about 12.81% per year. That's a strong return. And one of the things that Matt pointed out just recently on one of his slides was that if you earn 12% a year, your money doubles every 6 years. So stocks have done better than non-stocks. US stocks have done better than non-US stocks, and large stocks have done better than small. Let's go to the next slide, please. Looking at the first 6 months of this year, we see that the big decline in through June 30th anyway was a bit of an anomaly. This is a chart that shows annual returns of stocks against bonds. Stocks are shown on the horizontal axis down below. Bonds using the aggregate bond index are shown on the vertical axis to the left. And you can see there's only one dot in the bottom left-hand quadrant, meaning there's only one period where stocks and bonds were falling and posting losses at the same times. And that was the first 6 months of this year. So it's a bit of an outlier. We normally, will diversify between different asset classes to try to smooth out the return experience and gain some consistency in our rates of returns. And what was really unusual about the first 6 months of this year is that stocks and bonds were losing money at the same time. Next slide, please. Having losses over shorter periods of time in the stock market is normal. And this is a chart of the last 32 calendar year periods that shows the return for each calendar year, but it also shows losses that were incurred in the stock market within those years. In the average year of the last 32 years, the stock market produces a loss of more than 14% per year. And in recent memory, one of the things that's more fresh in our memories is the year 2020, where even though the market posted a return of 16% for the entire year, when the global economy shut down because of COVID, the market fell 34% over a very short period between February and March, yet ended up being a positive year. So these drawdowns are, again, normal. They come with the market, and we just have to plan for them. And that's one of the reasons that time horizon weighs so heavily in our discussions with clients about investment policy. Next slide, please. So Section 115 trusts are not going to be invested just in stocks or just in stocks and bonds, but to assist our clients in kind of benchmarking returns and putting them in perspective, we like to look at what we call naive, simple benchmarks. This is a 60-40 domestic portfolio, 60% stocks, 40% bonds, and this is as of June 30th of 2022. And for the year, a balanced portfolio would have lost about 10.5%. You can see both stocks and bonds were down over the last year. Over the last 5 years, the portfolio would have made about 7%, but all of that came from the stocks. Bonds produced very little in the way of help. Same for 10 years. Total return would have been about 8.3%, but mostly coming from stocks. And for 20 years, about 6.87%. This would not have been an easy benchmark to beat, by the way, because most portfolios take a global approach. And if we go to the next slide, this is a global naive benchmark. And you can see the returns here are a little below those of the domestic portfolio. So we use the MSCI All Cap World Index to kind of capture all of the stocks that are in the investable world. And then the global bond, the global aggregate bond index to do the same for bonds. And similar to the domestic portfolio, for 1 year, this 60-40 index portfolio would have been down over 15%. So very, very tough year. But again, time horizon is everything. In the long run, this same portfolio for 20 years would have produced almost 6%. And we don't put that number out there lightly. This is, a this was a period of very low inflation and very low interest rates and falling interest rates. And so it was actually a very good period for real net of inflation asset growth. And then next slide, please. This will be my last slide before I turn it over to Carlos. But instead of looking back, now looking forward, this is the US Bank 2022 capital markets assumptions. Most firms put out either capital markets assumptions, or some call them capital markets expectations, where we're asked to look forward by asset class and provide some insight into where markets are going to go. There are so many layers of assumptions involved in creating these market expectations that what's really important about them is not so much exactly where the number is, but directionally, where do we see them going? And I've looked at dozens of capital markets expectations from a lot of investment management firms this year. And suffice it to say, expected returns going forward are going to be less than what we've seen in the past 10 years. There's a bit of a reversion to the mean. We're going to not have falling interest rates on our side and some other factors. But we've also, at our firm anyway, we believe that some of the strongest return opportunities are going to come from private equity. And I put a note on here next to the private equity bar that shows that the median public pension return for the 10 years ended 12/31/21 was 8.5%. We don't see very many assets out there producing that kind of return over the next 5 to 7 years, which is our time horizon. So, you know, one of the things you're going to be hearing about is the rise in popularity of alternative investments, private investments, venture capital, other non-traditional investments that in partly due because of the scarcity of return expectations. So Dan, that concludes my brief review of where the markets have been. I'm going to turn the presentation over to Carlos Oblites, who's going to talk a little bit more about investment strategies.
Dennis, thank you so much. And I really want to echo some of the things that Dennis said. You're going to see 3 sets of different capital markets assumptions in this presentation, and the numbers are going to look different. And that's frankly because they came from 3 different firms, 3 different sources. And I would agree with what Dennis said. It just goes to show you how this is approached differently. I'm going to talk a little bit about this because there is a question on strategy, and I do want to hit it. The very first question that I want to tackle is I often get asked, what should local agencies consider when pairing their Section 115 trust strategy with their investment strategy? And if we go to the next slide, it's always important to think about what your objectives are with setting up a Section 115 trust. Because what you're trying to achieve, what you're trying to get out of it will drive a lot of the factors. Is this a rate mitigation trust? Are you indeed using this as a shock absorber to be able to help the budgetary process? Because investments to do that have certain implications versus just a portfolio where you're having a little bit of a side investment portfolio to perhaps come alongside of what you're doing in the pension. Often, that gets into some of the questions about whether you want to make additional payments to the pension or whether you're keeping them on the side. But at the end of the day, both of these may have different implications for what you end up doing on the investment side, and those have to speak to one another. What's your time horizon? How long is this portfolio going to be here? If it's a shock absorber, I would make the assumption that it might be in perpetuity. But I just want to make sure that the types of investments that we're talking about, I want to make sure that it is stated that the types of investments that we're discussing here are not, these aren't things that you're going to worry about on a quarter-over-quarter basis. Obviously, we all monitor these investments, in our case daily, but these are long-term investments over multi-decade periods where you're looking for results to be consistent over that period of time. It might be shorter, it might be over the 5 years, it might be over 3-4 years, but the shorter you get, the more constraints you're going to have on the portfolio. Thus, you have to think very carefully about time horizon. What sort of earnings are you trying to achieve? Because it's kind of hard to put your hands around that. when it comes to what you're trying to achieve on your side? Are you trying to stay are you trying to stay on top of whatever the pension is doing? The argument might come out that maybe you should just put the money in the pension. Are you just simply earning a rate of return that's producing a modicum of income that's going to provide you that shock absorber for the budget? And that expected rate of return that plays heavily when we come to develop strategies. I'll touch upon that in the next few slides. Are you going to require cash out of this, and how often? And remember that when you set these portfolios up, GASB does not allow you to take credit on your balance sheet, and that's a factor. And if that's going to play, if that's going to have an impact on the balance sheet, and if it's going to be a negative impact, what does that do for your overall financial position in the long run? You have to consider those things. Likewise, you remember that for any unfunded liability that you have at CalPERS, you have a growth factor on it, which is equivalent to the discount rate. It's like carrying a note, and that's a factor that has to be addressed as well when you're keeping money out of the pension. So those things I would couple with defining your level of risk. How do you define risk? And there's a couple of ways to look at it on a quantitative basis. It's really looking at some of the negative numbers that can come out of the markets. The last few months have certainly been a great example of that. The Great Recession in 2008 showed us samples of that. The dot-com bust in the early 2000s showed us examples of that. And if those, what kind of negative numbers can you live with? And then on a qualitative basis, how often are you okay coming to your city council or your board and going over those numbers and explaining that you had a negative return? Let's go to the next slide. The question is differences between strategic and tactical allocations, and if those can impact performance. And it's important to understand what it means when we say strategic or strategy versus tactical. I think it's a very important thing. So let's go. What I'm going to do is, if we go to this slide, page 21, I think it's important to understand when we talk about strategy, what it means. Strategy generally means, for anybody that's managing money, whether it's the pension or whether it's an external money manager or somebody who's an investment officer at a larger local government, they're going to have a philosophy of what they think drives risk and return. This is a study that was done many years ago, but a lot of people really go by this study. It holds true in many ways, and it's that asset allocation. When you think of all the decisions that you make in a portfolio, generally it's that asset allocation tends to attribute the most to portfolio returns over the long run. There's other factors that you can tweak with, security selection, market timing, are you a good stock picker? You have a secret sauce. I don't know what it is, but I can tell you is that the studies tell us generally that asset allocation is the biggest determinant. So most managers will address this in one way or another to determine the long-term direction of the portfolio. On a long-term basis, what direction are you headed, and does everything that you do move the portfolio in that direction? I can tell you in our case at Chandler, it is asset allocation. But we start with, if you go to the next page, with some capital markets assumptions. This is our opinion of where the markets are going to be on an annualized basis over the next 20 years. You notice that Dennis had his own. You'll notice that Ellen has her own, because every firm will have their own way to do this. CalPERS has their own, and they work with multiple money managers to come up with that. And this is a bit of a theme in the investments industry. But at the end of the day, you have to have a conviction of where you think markets are going and how volatile they're going to be. And there's a process to doing this. But along with that conviction, if we go to the next page, there also has to be an understanding, a mathematical understanding, that each of these asset classes that you're going to be including in the portfolio move relative to one another, some very much closely to one another, and others they don't. They kind of move randomly to one another. We call that correlation. But when I take the correlations and when I take our assumptions of where those returns are going to be, and when I take also the volatility that we expect over the next 20 years, we can now build mathematical portfolios via a model that kind of gives us an idea of how a specific blend of assets may perform over time. If we go to the next page, we take those blendings of assets and we diversify them in a way that gets rid of things that you're able to diversify away. We call that unsystemic risk. Systemic risk, the other kind of risk, is stuff that happens to everybody and you can't diversify away. But the idea here is that you don't want to take on, to achieve a greater return, you don't want to take on more risk than is necessary to be able to generate that return. So here's the idea. What you're looking at is called the efficient frontier. And it basically says that along that line that you see in that graph, you're building different blendings of your asset classes such that you've optimized it to get rid of that unsystemic risk. So why am I showing you these technical slides? It leads up to something. Let's go to the next slide. When we build a strategy, a long-term strategy for a portfolio, generally what we're trying to do is we're trying to focus on that dark green line down at the bottom, which says model expected return. You're trying to build a portfolio that's expected over the long run, over 20 years or so, to generate a return that averages somewhere around those numbers. And the different columns represent different blendings of portfolios which might generate that, and it'll give you an idea of what that's looked like in terms of worst return and best return and the standard deviation, to give you an idea of how volatile you are. But if you look at these allocations, look at the stocks, just look at the sort of semi-green stocks, bonds, and real estate. Notice commodities is missing. I'll get to that in a minute. But the different blendings basically blend in different proportions, stock, bonds, and real estate. And obviously, the more you have in equities, the more you have in stocks, the more volatile at least it tends to be. And I've excluded private equity here for a reason. We'll talk about that in a second. But the idea here is that based on the expected return you're trying to achieve, that might inform the allocation you have, again, vis-a-vis the amount of volatility that the assets may carry. Why does this all matter? Let's go to the next slide, and I want to kind of highlight this. So I took allocation number 4 that I put in there, and you can see that we have now an investment policy, and in that investment policy, we now have targets which tell us this is what we're trying to move towards to have in bonds, fixed income. This is how much we want to have in equities, real estate, and commodities, and so forth. That target, in a sense, if asset allocation is your philosophy, that target is basically your strategy. Your strategy is to stay somewhere near that target. Let's go back to the question, which is, what's the difference between that and tactical decisions? And does that impact the return? And the answer is, the difference is that the tactical is the short-term moves that you might make along the way, because these assumptions, these targets were built with long-term assumptions. But as you go along, you may notice that there are additional risks to certain asset classes that are presenting themselves in the markets due to macroeconomic and market conditions. You may notice that there are opportunities that have crept up for a given theme in this year, and you can tactically move away from your target by overweighting that asset class or underweighting it. You're making a tactical short-term decision to be able to make the case that you can kind of juice up the return a little bit or reduce the risk. And that's what we mean with tactical. Now, the impact here is that if you call it correctly, you can help the return along the way. But at the end of the day, that asset allocation over the long run, at least per our philosophy, is that that's going to drive that long-term strategy. Can you call it wrong? Absolutely. I know managers that on a strategic basis, notice that in this example, commodities are 0. But they might include it on a tactical basis. That's an inclusion of an asset class that you might make a decision. Had you made that decision for this year, your portfolio would have looked great the more commodities you added, because commodities have outperformed everything else. Had you added it in other years, you might have been left behind. And this is kind of where I bring in the public investments versus private investments, and that's that private equity, which the pension uses heavily, and certainly help the returns this year. You can use it on a tactical basis, meaning on a short-term basis. You can have it as part of your long-term approach. Those are all acceptable. Those are all good. But the decisions, the tweaking that you do along the way, can have an impact along the way. But remember that I think Dennis said everything reverts to the mean. I would definitely agree with that. And over the long run, your targets, if you stay to your targets and your assumptions are somewhere near where they should be, the capital markets assumptions we showed earlier, that will have the biggest impact. I have one more question, and I'm going to wrap up with this very quickly, which was, how do we address the possibility that Section 115 portfolios incurred steeper losses than the pension? Well, yes, of course. Let's go to the next page. You have to understand the differences between what you're doing in your program and what the pension is doing. Because of the size and resources that CalPERS has, they may have access to different invest or asset classes that you may not have in your own provider at home. And when you're talking, and I'm thinking about private equity, and that might have an impact. The other impact that you may have is that for strategic reasons, you decided to have an asset allocation target that was different, perhaps more conservative than what the pension is doing, and that has to be understood. There's different asset classes. I mentioned private equity, but also commodities and other things. There's also timing. The pension runs on a perpetuity. You may have a horizon, you may have a shorter horizon. It just varies the way that you set it up. Those differences have to be understood. Because you're not just mirroring the pension, unless you're just mirroring the pension. And then we have to kind of question, well, why are we mirroring the pension? Is there a good reason for it? I'm not saying there shouldn't be, but if not, if there isn't a good reason, you may just want to put your money straight into the pension. Is it okay? Is it okay if you underperform? Well, I would turn that question around and say, are you meeting the goals you set up for your trust? Is it providing income to absorb the shocks of changes to your budget because of normal cost changing every year? And because of your actuarials, because of market conditions, because of the change of your personnel, you name it. Okay, are you meeting your goals? Are you getting somewhere near your target? If you're not, then maybe it's time to come back and revisit your allocation and revisit it also not just on its own, but vis-a-vis whatever the pension is doing. Are you generating the cash? This goes back to the very first slide I started with. Let's talk about the goals. How's your horizon being impacted? And if you're weighing a pivot, what you want to do is you always want to think about, is there a better place where I can deploy my money versus where I'm doing it now? Those are questions that any good pension manager at a city is always, or someone who's tasked with overseeing paying the pension or managing or overseeing a Section 115 trust. These are the questions you want to ask yourself. I'm going to pause there. We've got some more good stuff coming from my friend Ellen Clark, where she'll go into more detail from there. Let me mute myself here.
Thank you, Carlos. Well, I get to answer the question, well, why not just select the best performing asset allocation? As Carlos just said, 90% of the return of your portfolio is going to be determined by the asset allocation that you choose. And one of the most challenging decisions that you'll have is to choose the right asset allocation for your circumstances. So it really goes back to your objectives. On this slide here, you see the middle of the page shows these white boxes, which are asset allocation portfolios, blending together the different asset classes that we also see. We call this the quilt chart. And one thing that you'll see, look across the top and you see those dark purple boxes. That's real estate investment trusts, which can be blended into the portfolio. And real estate investment trusts have been at the top of the chart there 3 different times. But if you go to the far right and you see where we look at volatility, real estate investment trust has also been fairly volatile. So having an asset allocation that's in the middle of the road, you get more return per unit of risk, and you see that the risk of the volatility of the portfolio is now down at the bottom part of the chart, the bottom 2/3 or third of the chart. So let's just look at 2 different portfolios. A very conservative, what I would consider a conservative portfolio, portfolio allocated 30% to stock and 70% to fixed income. And let's look at 2 time periods. And this is looking in the rear view mirror. 2 time periods. If I selected that portfolio in 2019, I actually would be selecting the best performing portfolio for that year if I selected my conservative 30-70 portfolio instead of a 70-30 portfolio, the opposite, 70% in equities and 30% in fixed income. And this year, if I'd last year selected that conservative portfolio, that portfolio has not gone down as much as the stock portfolio, or the 70% stock portfolio. But over the longer period of time, the 3-year and 5 years, you see that the more heavily weighted stock portfolio does quite a bit better. So it goes back to, what are your objectives? What are you trying to achieve? Are you trying to gain a rate of return that is higher than or competitive with a pension return? Are you trying to stabilize your budget and have those monies be available so that you can supplement your contribution to CalPERS? Those are the sorts of things that are going to determine how you're going to invest the money and what asset allocation would be the right asset allocation to select. Let's go to the next slide. And this is looking at the return projections on the intermediate and long term for looking forward now, instead of looking back, looking forward. What kind of variability of return you might experience for different types of portfolios. So I've got actually 4 portfolios here. One is a California code portfolio, so short-term fixed income. And our expectation going forward is that that portfolio over the near term, I'm going to call it that the intermediate term, the next 5 years, isn't going to give you a whole lot of return. Maybe a 0% return, maybe a 1% return. If you allocate to a portion of the portfolio to stock, 30, 50, or 70% to stock, the expectation is that you're going to have a higher rate of return. That doesn't mean that you're always going to get that return. And you can see that the wide band there in the 1 year is the range of outcomes that could happen. So let's think about this year right now, where we are today. And where we are today for a balanced portfolio, let's just say that 50-50 portfolio, we're in the negative territory. We're in that -2% to -10% territory, or looking over the last 12 months. But over time, as that money is invested, that range contracts. And that's what the 5-year and the 30-year show you. They show you that the range of outcomes contracts and that you are continuing to expect to have a higher rate of return. If we go to the next slide, what you really need to consider when choosing your asset allocation is what your objectives are and balancing those objectives to avoid the consequences that could happen. So if you don't have a portfolio that has enough risk in it, you're going to have perhaps those contribution requirements rise and not have enough money in the portfolio to supplement those contributions that you're making to CalPERS. If you chase return, that's going to escalate the risk of the portfolio. So then you have a year like you have this year, and you have to tap into the portfolio, and the portfolio value has suffered because of the decline in the markets. But if you don't take enough risk, if you don't take enough risk and you don't have that money in that reserve account, that could have a negative impact on the budget. You could have less money available to spend on other things that the city or the county or the agency has to spend on. So you need to balance your objectives to achieve your goals and avoid the consequences that may occur. So that completes that section. Now let's talk about what to expect from the markets. And as both Dennis and Carlos have said, we all have different capital markets assumptions. We don't have a crystal ball, but I will do my best. If we go to the next page, we all are expecting that returns on a going forward basis are not going to be as robust as they have been. PFM is looking for something in the neighborhood of 7 to 8% returns on equities, not only in the intermediate term over the next 5 years, but also in perpetuity over the next 30 years. On fixed income, if you look there in the middle of the page, we are looking for modest returns out of fixed income. The fixed income markets have been very painful over the last 6 months. We expect those markets to continue to be a bit painful throughout 2022. But over time, we are expecting that bonds will give you not only a nominal rate of return, but a real rate of return. And we haven't enjoyed a real rate of return on fixed income for some time now. So something in the neighborhood of 3 to 4% on fixed income on a long-term basis. And then you can see some of the more lofty returns that we're expecting out of the private markets, private equity, private real estate, and private debt. So suffice to say, our expectations going forward is that returns are not going to be as robust in the equity markets as they have been. The private markets are likely to give you a bit better return than the public markets, but with investing in the private markets, you have illiquidity risk. Let's go to the next page. What are some factors that we're watching or that you might want to be watching as we look at the markets today? We all know that inflation is driving a lot of behavior in the marketplace right now. Interest rates continue to go up and are expected to continue to go up through the end of the year. We're having to pay more for food and energy, and that's affecting the consumer. The consumer sentiment is at an all-time low, and consumer spending, though it posted a flat reading this week, is expected to affect lower growth on a going forward basis. Corporate profits and revenue remain pretty strong. Our expectation is that corporate fundamentals will remain pretty strong. So the big question is there a recession ahead? Well, I think probably. How deep will that recession be? We're hoping not very deep. You know, we've got some other factors that are positive that are affecting the market. We have good employment numbers, and we still have a lot of money in the system to be spent. So that's the big risk on a go forward basis, is what's the recession going to look like? How deep might it be? How long might it hang on? And I think that what happens with inflation is probably the key to the answer to that question. So that's what I have to say about the markets going forward. I'm going to turn it back to Dan to wrap us up with some key takeaways.
Thank you, Ellen. And as you may be concluding after hearing, you know, a lot of this expert advice, there is more to a Section 115 trust than just picking a provider and throwing money into it. You do have to think about a number of variables, and you know, hopefully we brought some food for thought to take home. You know, slide 19, Carlos talked about the number of factors that you may want to consider, because there's a very common response from public agencies, in my experience. Well, they haven't really thought about, they set up the trust, they're putting money into it, but how they plan on using it perhaps hasn't yet been determined. And I would, you know, at least want folks to consider, well, you know, if you haven't defined how you plan on using the funds, how then are you sure your agency picked an appropriate strategy for the use that has yet to be defined? And that's what these experts on the panel can help you navigate those tricky questions. But you know, some of the benefits of funding your pension liability, of course, you know, stabilizing the budgetary impact. You've heard from GFOA, you know, many times that cash is king, and having a budget that provides you know, where you've considered built-in budget flexibility, having those kind of multiple escape routes, and the Section 115 plan may be that use or means to stabilize the potential need for you know, adverse you know, either market impacts or in the broader economy. It you know, improves the stewardship of your public funds, and increases your overall funded status, even if you don't get to take credit for it. You know, at least in the pension 115 trusts. So you know, while it does increase your overall funded status. We know that on the balance sheet, you don't get to take credit for it, but it doesn't mean it is not an asset that will help you make those or navigate those difficult times, or just the general expected volatility. So a lot of benefits in doing so. I want to remind folks to use the Q&A or use the chat box to post your questions while you have the opportunity, and have these experts available to answer some of your questions. Really that last, bit is by pre-funding, thinking through and pre-funding any of your obligations helps fulfill your fiduciary responsibility, as the finance director, to plan for your long-term liabilities, whatever they may be. I do have one question thus far that as we move into question and answers is the city I work for issued a POB that has been favorable. How would a 115 trust benefit the city if we already have a POB, and how would we distinguish between the two when presenting to city council? And I'm assuming this agency is saying, if I'm at 100% funded, does it make sense to still have a 115 trust? So who would like to take that question?
Dan, I'll just briefly weigh in. This is Matt Goss from CalPERS, if that's okay, and then I'll open it up for my colleagues here, my peers on the panel. But when issuing the POB, you're basically borrowing money to pay it back later to take care of a problem that you have related to pension debt. So that's the UAL side of the pension cost coin. And I think it's a good move if you get the margin that you believe will work well for you over the term. But that doesn't address normal costs, which are perpetual and ongoing, and also very volatile and expensive in that they're a large slice of your budgetary pie every single year, probably. And they go up and down in the short term, even though long-term pension annualized rates of return are usually pretty consistent with the expected rates of return or the discount rates that they use. So I would argue that what you're doing with a POB is borrowing money today to take care of a problem that exists in the past and just continues to be problematic for you in terms of your annual costs. It doesn't do anything for the future like a 115 can do. And if somebody wants to piggyback off that and add to that, that'd be great.
So I would agree with Matt. This is Ellen Clark. I would agree that you're achieving some different objectives. With the pension obligation bond, you're paying off your unfunded liability. With the Section 115 trust, you likely would be using it to mitigate budgetary impact of variability of your contribution. So that's how you would communicate it to council.
One of the other questions I hear quite often is, should I put, if I've got some extra surplus or money that I know that the city can afford to part with, should I put that money, should I make the contribution directly to CalPERS, or should I put it into a 115 trust? Who would like to take that question?
Matt, you can go first.
I'll just start. I'll do the same thing I did last time. I got this was the most commonly asked question, and it has continued to be the most commonly asked question that I get. And I say you should use both tools, because with one of the tools, the additional discretionary payment, it's in a way like an annuity, because you're paying interest on the debt that you have in the pension system. And so if you pay off those bases of debt, you're eliminating those interest payments that you have to make. And so the the gamble that you're taking is you're saying, I'm probably going to come out ahead by doing this. And I think it wise, but I also think money doesn't grow on trees. It's not unlimited. And so with the money that you have to think about your future as well. And so if you had $1 million, would I use all of it for an additional discretionary payment? No, I would use some of it. And then I would use the remaining proceeds to put in a 115 trust, and even a little bit in short-term fixed income for the very near term in case I have some trouble. And then I'll pass the baton to Ellen. Thanks, Ellen.
So I have a little bit different take on it. I think it depends upon what your objective is. I think it's always good to save on your interest expense at CalPERS. But if you are concerned, if you're an agency that's concerned about your budget and about having to reduce other services, I think that's when the Section 115 trust can come in and be a very good tool for you. So I think that it depends on your circumstances as to what you might do. And I would advocate that you do want to significantly consider paying the money to CalPERS to save, as Matt said, that interest expense. But if you are concerned about your budget and the ability to pay your contribution on a going forward basis, that would be a reason to use the Section 115 trust.
I might add another dimension to all of this, and it's that because of the nature of a finance director's job at a city, sometimes you wear multiple hats. Sometimes you're really focused on the next fire that comes up. Sometimes it's just budget season, and you can't. What I'm trying to say here is, if you do decide to fund a Section 115 trust, it's not sort of like putting your money in LAIF where you can sort of put it there and not have to worry about it and move on. You need to be constantly going back and reviewing if your program, if what you set up continues to meet your goals. Does it continue to provide that shock absorber? Does it continue to help you from a budget perspective? And I would say that if it doesn't, you need to kind of think about what changes you need to make or whether you need to eliminate it altogether. Generally, people don't get that extreme, but it's just something that needs to be monitored regularly. Obviously, it's a long-term approach to investments, but you do have to think about whether it's really meeting your goals or not.
Okay, here's another excellent question submitted. If our current portfolio is predominantly bonds, based on the long-term investment return information Ellen discussed, would you recommend adding more equities at this time? Who wants to take that loaded question?
Oh, isn't it Ellen? I mean, they used her name in the question. We got to start with Ellen.
I'll take it. I think it goes back to your objectives and what you're trying to achieve. I would tell you today that both bonds and stocks are much more reasonably priced than they were 12 months ago. And what do I mean by that? We're having to pay less for stocks from a price earnings standpoint today. And also on the fixed income side, we're paid more interest income for lending our money. So I would argue that both bonds and stocks are more reasonably priced today, and that you need to go back to what is your long-term objective and how are you going to use this money? What's your time horizon? When are you going to draw the money out of the portfolio? And those are the answers to those questions should drive your strategic asset allocation. If your time horizon has increased, perhaps you can and afford to take more risk and add more to equities. But equities are more volatile. We see that right now. You're experiencing it, and they will be more volatile on a going forward basis, and they will not provide us with the same kind of robust double-digit returns that Dennis showed us earlier over the long term. I just don't think that the market has that kind of growth in it on a go forward basis.
Okay.
I hope that answered the question.
I think so. Did anyone want to follow up on that before I move on to another question?
Just briefly, I would just say that this is where using more than one tool becomes important. You know, a tool with 30% equity is going to have more risk than a tool with no equity. And so if that's the case, then maybe you split some of your money and use tool A for the shorter term, and then tool B for the longer term to get a better yield. Go ahead, Dan.
Yeah, so this next question is a bit of a market timing question. With the understanding that private assets, including private equity, may not have seen the lumps that public equities have endured already. If you were to invest money for this next fiscal year, would you choose to put it in the CalPERS or in a portfolio that has private assets, or would you present it, make the contribution to a portfolio that is primarily composed of public assets or public equities and fixed income?
So to rephrase the question, Dan, the question is, if I'm going to take money out in the next 12 months, would I invest in private investments versus public investments?
So yes, if an entity has actually surplus assets and they're looking to choose a portfolio that has private equity or is predominantly public equity, given that public markets we know have really taken their lumps, would you consider putting it in a portfolio that has private equity in the short term, or one that was more geared towards public equities and public fixed income?
I'm just going to make this quick comment. I get nervous when I hear for the short term and private equity in the same sentence, because those, and I see my colleagues smiling, because those are definitely intended to be long-term assets, and it just depends on your expectations for that strategy. Are private investments doing better, or have they done better? Yes. Remember that those are very difficult to value. Indeed, even when PERS values them, I think they value them a quarter behind. So it's making short-term moves like that, perhaps as a tactical approach. Just understand the implications. If the asset is illiquid and intended for a longer approach, that has to be factored in. But from a strategic standpoint, we would want to see what it does to your overall expected return, what you're trying to achieve, and overall risk profile. If the volatility is going to go up, and are you comfortable with it? Those are the questions that I would ask. I don't know if
I agree. Carlos, could I just add one thing with, the CalPERS example of using increasing private equity, private assets, I should say, over time incrementally, which is part of their investment policy today. CalPERS has not changed with respect to the fact that it's a very long-term investment as compared to most of the other tools that we've been discussing. So if you use CalPERS as a model and you say, hey, they're using more private today than they were, a few years ago, you may not be comparing apples to apples, because you may be talking about a much shorter investment time horizon for pension contributions in the next 5 years of your job as a finance director. So it's important to establish what you're talking about in terms of time horizon. I think that just kind of seconds what Carlos was saying, or that was my hope, at least, Carlos.
Yes, it was.
You need to keep in mind that, in my opinion, for Section 115 trusts that are looking at a time horizon of under 10 years, you have no business in being in private equity or private debt, because the time horizon for a private equity investment or a private debt investment is at minimum 7 years and could go out to 10, 12, 15 years. So I think it all goes back to time horizon and objectives, and what you're going to use the money for and when you need to access the money. Certainly you are being paid some additional return in the private markets. And part of that is because the investment is illiquid. It's not something that you can turn around and sell tomorrow and get your money out. So again, I would go back to, what's your objective? What's your time horizon? And is it an appropriate investment for your particular portfolio?
So we are, that was the last question in the queue, and we're about 7 minutes over our time. So I will call it a day. I want to thank our panelists for providing a wealth of information, and they are a huge resource to local agents and finance directors. I don't feel you have to make these decisions alone. Please do reach out to these agencies if you have questions. They are experts and can help you navigate these very difficult questions. And with that, I will say thank you. We will send out the presentations by the end of the week. And Kristen, is there anything else that you would like to conclude with if you're on the line?
No, thank you everyone for joining us today. If you have any questions, do shoot a note over to success@govinvest.com. Within 24 hours, you will receive a link to the recording of this presentation, as well as a copy of the presentation slides as a PDF. So have a great rest of your day.
All right. Thank you to the participants. Thank you to the panelists. Have a great afternoon.
Thank you.
Thank you, everybody.